All right, so welcome to my TDFA video assignment. My name is Floris van Duijn, and today I will talk about the following chapters. So first off, I want to discuss what derivatives are. I chose this subject because I knew they existed derivatives, but never really understood how they worked. From like you see them, I saw them like in movies or read them in articles, and yeah, they sounded really complicated to me when I looked up the technical terms for it. So now I do know, of course, because of the TDFA course that I followed. So yeah, they're really interesting to me and want to use them more in the future. The next chapter is about candlesticks. This is because, yeah, also really interesting subject. Also, I saw them a lot. I did use to trade a bit before this course, and I saw them, but never understood how they worked or where they originated from. So yeah, now I do also know, of course, and yeah, I think it's very interesting to know how these work. So that's why I also wanted to explain these as well. And finally, I will do a technical analysis. We will do this with the sushi perp, and I will share my screen so you guys can follow along on TradingView. So the first chapter, derivatives. Now, the first question that we want to ask here is like, what are derivatives? I read this as well for the first time, and I like it didn't make it very clear to me. So I will read the technical term first, and then I will explain it in like easier terms what it is. Technical term is that a derivative refers to a type of financial contract whose value is dependent on an underlying asset, group of assets, or benchmark. And a derivative is then set between two or more parties that can trade on an exchange or over the counter. Now, as I said, this is quite complicated. And yeah, I also didn't really understand this when I first read this. So then I looked into it more. So basically, what a derivative is it's like a contract between, as I said before, two or more parties, and the value of this contract is determined by the underlying asset or assets. Now, I will explain this more with an example. This example goes as follows. I made a graph here. I will explain this as well. There's two parties. There is a grain seller and a bread manufacturer. Now, of course, grain is used in bread, so these people rely on each other to make a profit. Now, the blue line is the one from the grain merchant because he wants to sell like this axis, this price on the y-axis, and the x-axis is how much he sells or how much is sold. So, of course, a grain merchant wants to sell a lot of grain for a high price, but the bread manufacturer wants to buy a lot of grain for a low price because, yeah, the grain merchant, of course, wants to make lot of as much profit as he can, so that's why he wants to sell it as high as much as high as he can. And the bread manufacturer, of course, wants to keep his costs down, so therefore he wants to buy the grain at a very low price. Now, what they can do is they can have a derivative set up for the future. So, say for example that the market price of grain is around $20, and in the future, the grain merchant thinks that the price of grain will fall, and the bread manufacturer thinks that the price of grain will go up. So, of course, they are conflicting because they want different things, and they set up a derivative. So they set it up for $23 in the future. Now, what does this mean? This means that in the future, at a given date, the grain farmer is forced to sell his product for $23. Doesn't matter what the market price is at that moment. It says in the contract, I will sell it for $23 in the future to the bread manufacturer. So in this example, like if the market price is in the future at the future date where this contract like is goes in effect is $25, so $2 above the contract stated money, um, then it is very good for the bread manufacturer because the market price is 25 for 1 unit of grain, and his derivative says that he can buy it from the grain merchant for $23. So the grain merchant, of course, is not very happy because he could have sold it for $2 more. And that's why people use these derivatives in order to lower the risk of market fluctuation. So, for example, in this example that I gave, the bread manufacturer did very good by having this derivative set up. Excuse me. We have a lot of, we have four types of derivatives that I will go through. The first is forwards. This is the type of derivatives that I explained before in the example. The thing is with forwards, you are obligated to sell or like do the transaction that is stated. So you cannot say I don't want to do it because it is forced. And forwards are not exchanged on exchanges, so they're not regulated as much. Futures are like forwards the same, but they are traded on exchanges and therefore they are more regulated. Then we have the options. Options are like the same, but with options, as the name states, you have like the option to buy or sell um, the asset in the future at a given time. So, in the example of the grain merchant and the bread manufacturer, the grain merchant can say, "Well, the price is now too low for me. It's below market, so I will not do this transaction," and then the contract is void, basically. And the last form of derivative markets are swaps. This also is quite logically because of the name swaps. There's no like transaction of money for a given assets. It's like assets for assets. So you swap the assets basically. Okay, I hope this is a bit clear. Now we will go to candlesticks. Here we can also ask the question, what are candlesticks? Well, I have a picture here. On the left, well, I'll first explain what bullish and bearish means actually. Bullish means that the market is going up, so these are indicated in the graph with green candlesticks, which are these. These are candlesticks, by the way, if I not made that clear yet. They are usually standard in the most tools that traders use. They are green, so green of course means good, and the market is going up, which means that the market price for this asset is also going up. Candlesticks have bodies, which is like the thick part over here, and the smaller parts that are extending above and below the candlesticks are called the wicks. Um, yeah, this is the same for, of course, the bearish, which is when the market is going down. Candlesticks, yeah, also they have wicks and bodies, and these are indicated in red, so that's easy to see in like a graph when the market's going up green and the market's going down red. Very simple for the traders. The one difference between these two is the open and close levels. So a candlestick works as follows. Candlesticks always start off where the previous candlestick ended. I will also make this clear in the graph, but they open here when they are bullish, and of course the market went up, and then they close at this level. And the wicks basically indicate the highest and lowest price that is reached during a specific time frame. And time frames I will also explain graphically. So I will take you along with me to a graph that I will show. Oh, this is not want this screen to show. Yes, thank you. And then, well, okay. So this is also for later. I will also use this. Here we can see some candlesticks. So as you can see, this is a bullish candlestick. It closes here. So we will look at, that's not a good example actually. Let's see if we can find a nice one. Here, let's look at these two. So this is the previous one. Now we will look at this one. This was a bearish candle. So it closes here and then it opens again here. Now during this time frame, the maximum price price that was transaction that found place was like at 1.2822. The lowest price that was reached was at 1.2507, and it closed at 1.2719. Now the next one is bullish, of course, so it opens here below, and it goes up here. This is where it closed, and it reached the maximum price of 1.2914 and the minimum price of 1.2463. Now this is on a 50-minute, it says right here in the top, 50-minute time frame. This means that every candlestick represents 15 minutes of trading, and then it is closed and a new candlestick is formed, basically. You can also have it on 30 minutes. So now each candlestick represents 30 minutes, and you can go up to whatever you like in every way, basically. All right, I hope that is clear. I will now get back to my presentation. Yes. Now, there are also some candlestick patterns that can be recognized. I won't go over them all, but like for bullish patterns, there's the hammer, for example. So you can see what happens, like they're very small bodies and very high wicks at the top. Yeah, you can also see like these are with three and these are with two candles that are seen. Yeah, so then you also have the neutral basic patterns. They don't really indicate anything. And of course the bearish, well, this is a hanging man, so also again smaller bodies and usually long wicks at the bottom here. Yeah, so these are all interesting to look at during trading, and traders of course use these when making a decision whether to go long or short, or how they trade their assets, or what they want to do in a specific market. So now I'm going to my technical analysis. Um, I will also share my screen again for this again. If I no want to share this. Cool. So as before, we are looking at sushi. I have already put in some drawings just to make it clear. I think I was on like this level. And we want to be like, of course, towards the end. Yes. Make it a bit smaller. All right. So what I put in here is a horizontal level on this level. During the day time frame, of course, we did deal with a big crash over the last days, but nonetheless, we can still make an analysis here. So there's multiple touches here, and further along, it is used as a support line again here. So that's a very interesting horizontal to look at. Then I also put one down below here. There's also multiple touches. Even during the big crash, it touched again here and then went up later. Yeah, so that's very interesting. Then we can move on to 4 hours. Also a very interesting line. I put in a horizontal here as well because two touches, and here you could see better on the lower time frames. It like yeah, it was interesting. So oh well, you follow my usual pattern and again go to 1 hour. So as you can see, multiple touches here. Was also a bit of resistance here, and again some support here. Then here it touched again, so that's why I also put in this horizontal. If you then go to 15 minutes, you can scale it up a bit so it's more easier to see. So these are our lines that we drew. Now I saw here a little bit of a wedge where this candle broke out, which I thought was very interesting. So my idea here is that it will go up. I drew this here as well. I put in a long position, so a buy position. With this, we can see the numbers here. I took 3.18% risk. We can even increase this to about 5, so to have a bit more margin, but not too much. This means that if we have like a portfolio of $1,000, that if we hit our stop loss, which is then at this level, so at 1.2371, we will only lose around 5%, so that will be 50 euros, or in this case 4.67%, which mean 46 and 70 cents. Our risk reward ratio is also presented here. This means 4.71. Risk reward ratio is calculated by the reward. So in this case, we have 22%. Well, actually, this needs to be at this level. So 22.4% increase if we this is our take profit level, by the way. So this is at 1.5829. We have a 22% increase then in our portfolio. So that would mean that we go from $1,000 to 1,220 or something like that. Then the risk reward ratio, that's what I was talking about, sorry, is calculated by dividing this number, so 22.46% by 4.67. Well, 22 divided by 5 is around 4 or 5. This is written here as well, so that's correct. Yeah, and I have also drawn in, can put it a bit more like this. This is our entry price, by the way, 1.59, 1.2951, sorry. And I draw like a projection as well with my brush here. This is the blue line. I think I can make it another color. Let's make it red so it's more easily seeable. I think this is what it will do in the future. So it will go up because it broke out of this triangle and continue to grow, go down a bit and then go up. Of course, during a trade like this, you do want to monitor it because now we have like a very high profit, like 22.5% is very high. Like it could also happen that when you're monitoring it, that's around 13% or even at 10% profit. It's high enough for you, and you will liquidate your position. All right. Well, thank you for listening to this presentation. I hope it was very informative. Sources are linked down below where I got all this information, and yeah, this was basically it. Thanks for watching, and have a good day.